Hey guys, Dave Keller here with Market Misbehavior. Hope you're doing well. I love to ask interviewees what their one chart would be, and that is if you had one chart, just one chart, besides a regular chart of the S&P 500 to use to get a sense of the broad market environment, what chart would it be and why? So today, my one chart is Take-Two Interactive. So usually my one chart is more of a macro big picture type of thing, but today in particular, you have a lot of the video game stocks, things like Take-Two, Electronic Arts, EA, Activision Blizzard, ATVI, all reporting earnings this week or last week. And so sort of an opportunistic time to pay attention to those charts. And in particular, what we're going to do today is focus on Fibonacci retracements and how to use them in conjunction with earnings releases. If this sort of thinking about investor behavior, decision making, charts, and technical analysis is of interest to you, I hope you'll hit subscribe to my channel, hit the notifications, give this video a like if you could, and in the comments below, answer the question, which of these stocks do you feel has the best opportunity going forward in 2021? Electronic Arts, Activision Blizzard, or Take-Two, and why? Here's my one chart for today. All right, so today our one chart is Take-Two Interactive, TTWO. And doing this for a couple reasons. Number one, to talk about just the broader video game space and what patterns are emerging, but also to talk a little more broadly about Fibonacci retracements. This is a particular technical indicator that I get a lot of questions about. So I just wanted to focus on why Take-Two is a great example of the benefit of using Fibonacci retracement levels. So Take-Two, if you're not familiar, obviously a video game maker, and I tend to bucket them with EA, Electronic Arts, ATVI, Activision Blizzard, and Take-Two is sort of like the three video game stocks to pay close attention to. And in general, all three of them have had constructive long-term uptrends. Take-Two in particular really had a basing pattern here for the second half of 2019. So while a lot of stocks sort of accelerated into a high in January to February and then rolled over, Take-Two actually had made a lower high in January, a lower high in February. So it was really sort of accelerating. But if you look, because it had already been in a downtrend, it actually outperformed February to March, going into the March 23rd low, because it had already given up a lot. It had already broken down below previous lows. It had already been in a downtrend, while a lot of stocks were just sort of accelerating, and so they gave up a lot more gains on the way down. Since then, sort of tapered off a little bit into the summer and going into even the fall into November was sort of pulling back as a lot of other stocks were accelerating out of their September, October pullbacks. You can see a lot of this changed going into year end as Take-Two accelerated to a new high, broke above $200 a share. And since then, it's sort of tapered off a little bit. So while the rest of the market sort of broke into new highs, you can see the relative strength essentially sideways for January into February as the stock has done sort of hung in there. What's interesting about Take-Two recently is it broke to a new closing high, a new 52-week high on Monday, and then Tuesday earnings come out and the stock is back right down to its ascending 50-day moving average. You can compare that pattern to what you might see on Electronic Arts. And what's interesting is all three of these reporting earnings here last week and this week. Electronic Arts actually jumping pretty good today, but in a bit of what you might call a cup and handle pattern, sort of a rounded bottom and a shallower correction to its ascending 50-day moving average. A break above sort of 150 would be really constructive there. Activision ATVI has already broken out. So it actually hit a peak in August, broke above it. Resistance became support. It found support around 87.50, and from there has actually gapped higher. That was on last week's earnings release and continuing to push to the upside. So all three of these have been in constructive patterns. Take-Two is down while the other two are up today. So how do we use Fibonacci retracements to break down a stock like this? Well, first off, I'm often asked during earnings season, does it really even make sense to look at charts? Because it's not about charts, it's about earnings. And I would argue it's always about charts. And I'm totally biased by the fact that I'm a technical analyst. My career has been spent looking at charts and drawing conclusions based on the way you can quantify investor behavior. So I would argue it is always a good time to look at the chart as an aggregation of supply and demand or investor emotions, their emotional states as they make their buy and sell decisions. So I would say it's always a good time, and especially around earnings season where you're seeing quick jumps in stocks, those jumps, those gaps. So for example, Take-Two gapping down today almost 5.5%, 6%. Basically shows there's a change in valuation. Investors think one thing, you hear the earnings release, and you sort of recalibrate what you're seeing for this, or the potential for this company and this stock going forward. Here's where Fibonacci retracements can become really helpful. And I often talk about having a line in the sand. So when there's a big move in a stock, having a line in the sand at which you would agree to reevaluate a long position or reconsider your position. So if we look at Electronic Arts, focus back here after the March low, you see it accelerated up into this high in August. Then if we just take that to the side here, so we're basically saying March was the beginning of the move. It peaked out first week in August. That was the end of this sort of bull thrust to the upside. Now what? And if you look a couple times here, it pulled back to around 38.2%, the retracement level. What that is basically, if this is 100% of the move from March to August, this is about 38.2% of the way back down on the way retracing that uptrend. So, a stock in an extended uptrend will have a big impulse move in the direction of the longer term trend. It'll then pull back and sort of have a little corrective move as it, investors take profits. There's, an exhaustion of buyers, or sort of a resetting before a new set of buyers take control. There's a new influx of demand, a lessening of supply for whatever reason, and the price goes higher, right? More buyers than sellers, anecdotally, is what we talk about. When it breaks to new highs, then we recalibrate again. So now if we take this swing low from here in September, this is sort of the low that we made, and now we go up to the high that we had this last week. So this is basically the low from September, which was the base here. We've now made a new jump to the upside, and you can see we've exhausted potentially at around 215 if we take yesterday's high as the end of this potential move, and we feel that this earnings miss might cause it to pull back a little bit. What's interesting is, just like we had back here in the fall of 2020, we have what's called a confluence of support. The support level from January, from that pullback after the new year, is lining up beautifully with this 38.2% retracement level. So you have a couple indicators saying around $190 a share would be a reasonable pullback level, with this uptrend still being in place. So the general way that you would use this is, as long as we remain above $190 a share, remain above this swing low from January, overall the general positive uptrend is still in play. If we break down through 190, if we break down through the Fibonacci support, we break down through this swing low from January, and also that would bring it below its 50-day moving average. That would suggest potentially that there's greater risk of downside, and you need to think about downside protection and just how to manage increased likelihood or increased potential for the price to retrace a little bit. So Fibonacci retracements, in my experience, are not a trading system. It is essentially a visual cue. It's a way to quantify the impulse and corrective moves, this wave-like pattern that stocks tend to experience. And anytime a stock has had a big run, this is a really good opportunity to put these levels on and just see, in this case, when they line up with previous support levels, that gives you a really clear line in the sand at which you can still maintain a sort of a bullish bias. You can still assume that the uptrend is up until proven otherwise, and a break below that Fibonacci support, a break below that swing low, might be enough indication to convince you that that uptrend is no longer in place and it's potentially exhausted. You need to think about further downside risk. So that is our one chart for today, really focusing on Take-Two, subsequently Electronic Arts, EA, Activision Blizzard, ATVI, but focusing on Take-Two. Number one, to think about how to use charts around earnings, especially when you have an earnings miss, and how to put that within the context of a larger bullish move, but also the value of using something like Fibonacci retracements as a way to more systematically identify, draw a line in the sand, identify where you might expect increased risk of further downside. If this thinking of chart analysis, investor behavior, decision-making is of interest, go ahead and hit subscribe on the channel. Like the video if you could. Put a comment below. Let me know which of those three, Electronic Arts, Activision Blizzard, Take-Two, you think have the best opportunity going further on into 2021. From all of us at Market Misbehavior, be well. Talk to you again soon.